I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 4 videos on gaps. Microgaps are very small gaps and easy to overlook. They're gaps, for example, between the low of one bar and the high of a prior bar 1 or 2 bars earlier. A gap open bar is a bar where the open of the bar gaps above or below the close of the prior bar. And when the market gaps up or down on the next bar, it often is a sign of buying or selling pressure. Gaps mean strength. If you see a series of gaps, let's say going up, the market is likely to go higher. A body gap is a gap between bodies. In other words, the tails of 2 bars might overlap, but the bodies do not overlap. I also call that a negative gap. While not as strong as a full gap, it often still leads to a measured move. Gaps are common. Every trend bar is a gap. Every trend bar is an attempt to break out, and therefore it's a gap. Most breakout attempts fail, and the trading range usually continues. Most gaps, therefore, have no predictive value, and there is no follow-through. The market continues sideways or it reverses. Take a look at this bar. We have a trading range, and then we have a bull bar, a bull trend bar. Every bull trend bar is a breakout, it's a buy climax, and it's a gap. Here, there are different ways to draw the gap. The close of this bar, for example, is above here, so there's a gap between the close and here. There's a gap between here and the double top. And then look at the next bar. Look at its low. There's a gap between its low and the high of the bar before the breakout bar, before the gap bar. If a market is rallying and it's forming gaps, it increases the chances that the market will continue higher. I call that a micro gap. And you can see the market did, in fact, continue higher. Micro gap. I look at the high and low of the bar before and after a trend bar. So, for example, here we have a bear trend bar. I look at the high of the bar afterwards and the low of the bar before. If there's a gap, it increases the chances that the market's going lower. Here we have a bull bar. Every bull bar is a trend bar, it's a breakout, it's a climax, and it's a gap. There's a gap between this close and that high. I look at the low of the bar afterwards. Is it above the high of the bar before? It is, and that is therefore a micro gap, and it increases the chances that the market will go higher. The high of this bar is below the low of the bar before the breakout bar, and therefore a gap. The low of this bar is above the high of the bar before this bull trend bar, and there's a gap. There's also a little gap here between this low and that high, increasing the chances that will go higher. Here we have gaps again. The close of this bar is above the high of this bar, a couple bars earlier. The low of the bar afterwards is above this high and above the top of this tight trading range, and therefore there's a micro gap between this low and all of these highs. However, look what happened about 5 or 10 bars later. The market dropped below those highs and the gap closed. Here, another bull trend bar. The low of the bar afterwards is at or above the high of the bar before. There's a gap, but the gap closed on the next bar. Another bull trend bar, another gap between its close and the high of the bar before, but on the next bar, the gap closed. Again here, this bar, the close is gapping above that high, but the gap closes on the next bar. The bulls are no longer able to keep gaps open, and therefore the bulls are losing control. Higher prices are less likely. Pullbacks keep closing the gaps. And we did start to trend down. The bull trend ended. We had a bull trend and it ended. And now look what's happening with the bear bars. We have a trend bar. The high of the bar after is below the low of the bar before. We have another gap here. Here we have a pullback in a bear trend. The high of the bar is below a prior bar low and therefore a gap. The bears are starting to get gaps and they're staying open, and that makes lower prices likely. Micro gaps, if they stay open, are a sign of pressure. And we had selling pressure and the market went down. We have a bear trend bar and we have a gap between its close and the low of the prior bar, but the gap closed immediately with this bar. There is no gap between this high and that low. We have another bear bar and another bear bar. The close is below that low, but the gap closed on the next bar, and the high of this bar is above that low, so there's no open micro gap. The bears have a reversal down here. We have a gap this close and that low. We have a gap this high and that low, but the gap closed on the next bar. The gaps are closing. That reduces the chances that the sell-off will continue. Here, the bears are getting bear bodies, but they're no longer able to create gaps at all. That is a problem for traders hoping for lower prices. And then we started to get a series of bull trend bars. Look at the low of this bar at or above the high of that bar, the low of this bar at or above the high of this bar, the low of this bar above the high of that bar. We're starting to get a series of gaps. On the upside, that's a sign of eager bulls. Anytime the market starts to pull back to test the high of a prior bar, 2 bars earlier, bulls are buying. They're not letting the pullback fall below the breakout point. On a smaller time frame chart, this would be a small high, and then we pulled back and we rallied, and then we pulled back and tested that small high and rallied again. A micro gap on this time frame, increasing the chances that we're going to go higher, which we did. Gap open bars. When a bar gaps open, when the open of a bar is above the close of the prior bar, that's a gap up open bar. If the open of a bar is below the close of the prior bar, that's a gap down open bar, or a gap open down. We have a bull bar, and the open is exactly at that close. There's no gap. We have a bull bar, and then a bear bar, and the open is exactly at that close. There's no gap. However, look at this. We have a bull bar, and look at the open of this bar. There's a gap. It gapped up. There were so many traders eager to buy at the close of this bar. They placed market orders to buy as soon as this bar closed. The market gapped up. The same thing here, but they were overwhelmed by bears. Here we have a breakout, and here we have an attempted breakout that failed. Over here, we have a bull trend bar, and the market pulled back on the next bar. The bears tried to get a reversal. Instead, it became a pullback. A bull trend bar, and the next bar opened below the close of that bar, so we have a gap down. The bulls were hoping for a pullback, but the bar closed down here, and it therefore was a reversal. No gap, even though consecutive bull bars. No gap, even though a reversal. No gap. And here we have a gap up. So we broke above the high of this bar and had a good breakout bar. We broke out above the close of this bar and we got a reversal. We gapped down, but it was a pullback in a bull trend. The bull trend resumed. We gapped down and the bull trend ended and we got a reversal. Opposite's true in a bear trend. No gap. We have a bear bar, and then the next bar opened here. In this case, it was a bull bar. Here, no gap. The bar closed here. It opened exactly at the same price, and we had a bear bar. We have a bear bar, and then we gap down on the next bar. The breakout below that close and this low was successful. Here, we have a bear bar. The market's going down, and we gap down, but we reversed up. So we have a breakout here and a reversal here. a bear bar and we gapped up, but that became a pullback in a bear trend. A bear bar, and then we gapped up and we got a reversal. So we have a breakout and a failed breakout. We have a pullback and we have a reversal. Very strong bull trend, and every open is at or above the close of the prior bar. So as soon as the bar closes, traders are buying. They're buying, and here we have a gap up. So many traders were convinced at this point that the market's going higher. They bought the close and there were not enough sellers. The market had to go higher to find sellers, and we have a gap up, a sign of a strong bull trend. Same here, we have a bear trend, but a higher low, a micro double bottom. When the bulls saw this good bull bar closing on its high, so many of them were eager to buy, they bought the close. We had to gap up to get them filled. So the buy the close bulls here, there were so many buy the close bulls that they got filled above the high of the close. We have a gap. This doji bar, its open is above that close. Here we have a gap between this open and that close. Eager bulls probably going at least a little higher. Bull trend, but now look what happened. This open is above that close. We gapped up, but instead of the breakout succeeding, we reversed. When you start getting gaps up that reverse late in a bull trend, the bull trend is probably ending, and that means the market will either go sideways or possibly reverse. Look at the open of this bull bar. It's above the close of that bear bar, which is good for the bulls. But then look at the follow through on the next bar. We have a reversal. So a micro double top, up and down on that bar, up on this bar, down on that bar. The bull breakout is failing, and you got to be thinking the bull trend might be ending. In fact, the way the bears look at it is this bear bar is the start of a bear trend, and this gap up led to a pullback in what became a bear trend. Strong bear trend, the close of this bar and open of that bar, same price, and here as well. So we're starting to get reasonably good selling. The bars are opening at the close of the prior bar. That was not the case here. We're in a bear trend, but look what happened. Where were the sell the close bears? Why did the next bar open above that close? It's because instead of traders selling that close, there were a lot of traders buying that close, betting on a higher low. And that is a sign that the bear trend might be weakening. We gapped down here, but instead of a breakout succeeding, we got a reversal. And the same here. Look at the open of this bar and the close of that bar. We gapped down, but it reversed. The bear breakout attempt failed. Increases the chances that the bear trend is ending, and increases the chances also that we may begin a bull trend. This is a 60-minute chart of the euro versus the dollar. We're starting to get some selling here. Look at the open of this bar and the close of that bar. The open is below that bar's close. We're gapping down. The open of this bear bar is below the close of that doji bar. We're gapping down. Very eager bears. As soon as the bar closes, a lot of traders are selling the market, and the result is an open below the close. It's a sign of selling pressure, and it increases the chances that the market will go lower. We sold off for a couple bear bars, but it's possibly a higher low major trend reversal. We have a bear trend, a strong reversal up. We have a new low. We reversed up again, and now we have a higher low, so possibly a higher low major trend reversal. And the open of this bull bar, it's hard to see. It's above the close of that bear bar. We gapped up here. So the attempt by the bears to resume the bear trend is failing. The bear breakout is failing, and we are reversing. That gap up and the bull bar after the bear bar increases the chances that we'll go at least a little higher. You can see this open is above that close. We're gapping up here, further increasing the chances that we'll go higher. other gaps, small gap between this open and that close. Buying pressure increases the chances of higher prices. So pay attention to whether or not the market is forming gap open bars up or down, because they increase the probability that a trend will go further. If you want other examples on how to trade gap open bars, take a look at the videos on e-mini scalping. They're not quite as important for Forex markets because charts are not as precise with Forex markets. Every broker, every bank has its own chart. If you put all the charts together, you'd get an accurate high volume chart. But if you look at any one individual chart, the volume often is not all that great, and gaps are more common and their predictive power is less, especially on smaller time frames, like a 1-minute chart or a 5-minute chart. Gaps are a sign of strength. They're a sign of eager traders. We're breaking above a tight trading range, and we're pulling back. The bears are hoping for a reversal, and the bulls are hoping for a pullback. And you can see the lows of these bars are at the top of this bear bar and above this bar. And therefore, we're forming a gap. We get a reversal up, it increases the chances that the market will go higher, which it did. Every trend bar, I think of every trend bar as a trend bar, a breakout, a climax, and a gap. There's always a gap between the close and something before it. Big bull trend bar, it's a buy climax. The bull trend paused. It might reverse, but right now it's pausing. And you look at the reversal attempt. We have a micro double bottom testing this high, and the bears are not able to pull back below that high. There were some bears who sold this high, betting that this was a bull leg in a trading range. And they sold more higher. They're trying to get out break even at this high. They needed to fall below this high. And twice the market tested, but could not achieve their goal of overlapping this bar. These bears are going to get trapped if this market starts to go up, and they'll buy back their shorts and not look to sell again for many bars. So this is a good buy setup. Here's the pullback, a double bottom pullback, and here's the breakout point, and there's a gap. If this starts to go up, it may accelerate up because there will be trapped bears who will buy back their shorts. Increases the chances when you have an open gap after a breakout, increases the chances of many more bars in the trend. Going higher. You can see what happened when we got to a measured move. We have a gap. Here's the low. Traders tend to take profits at measured move targets based upon gaps. And you can see we stalled here. There was some profit taking there. Also, bear bar, big bear bar, some bears will sell with a limit order at that measured move target, looking for at least a scalp down. The trend is continuing up. We have another trend bar, and we have a gap between the low of this bar and that high. Bulls are hoping for another measuring gap, just like the one we had over here. And bears want this to be exhaustion, a wedge, 1, 2, 3, and then a conversion into a trading range or even into a bear trend. For the bulls, any prior higher low can lead to a measured move up. So we have several choices here. Here, here, here. The measured move would be from this low to the gap to up here. If it goes higher, then the bulls will look at the next measured move target, which would be this low, the gap, and up here. If it goes above that, they'll look at this measured move target, this low, that gap, and then up here. If the rally stalls around a measured move target, we have 3 choices. Bulls will take profits and bears will start to short. And here you can see the bulls took profits at a measured move from this low to this gap up to here. good location to take profits if the rally is starting to stall. This bull bar smaller than this bull bar, so loss of momentum, and the next bar is a doji, so even less buying. Good location to take at least partial profits. Body gaps, I used to call them negative gaps. It's when you have a gap between bodies and not just between the tails. It's not as important as an actual true gap, but it's still a sign of strength and often leads to measured moves. Big bear breakout, the bulls tried to get a reversal, but look what happened. The bodies here did not overlap any of these bodies. This tail went above the breakout point here and above the breakout point here, but the bodies did not overlap, and therefore we have a body gap. There's a body gap here. The gap at this point is between the highs of these bodies and the lows of these bodies. It can still lead to a measured move. It's still a sign of strong bears. The bottoms of these bodies, the bottoms of these bodies, the tops of these bodies, there's a gap in between. It increases the chances of lower prices. If we were looking at a line chart, there would be an actual gap. A line chart only looks at closes. So this little pullback, this would be the bottom of the line chart. Same with here, it only looks at closes. The market goes up here, this would be the low of the line chart. And it only looks at closes, this would be the high of the line chart, and there would be an actual gap on a line chart. Traders will look to sell on the reversal down from the test of the breakout point. They'll sell below a bear bar closing on its low, looking for about a measured move down. Look what took place here. We sold off strongly. We have a big bear bar. We still have a gap between this body and that body. But then what happened here? This body overlapped the bodies of the breakout point. When body gaps are starting to close and bodies start to overlap in the pullback and the breakout point, the bear trend is probably ending, which means the market will enter a trading range or a bull trend. Bulls will buy above strong bull bars for a swing up. Sometimes they'll buy for a scalp as well, but certainly a swing up. Bear trend, strong bear breakout below a trading range. The bulls tried to get a reversal, but look what happened. Yes, this bar's high was above that bar's low, so the gap closed. But the bodies, look at the bodies. These bodies did not overlap any of these bodies, and therefore we have a body gap. We have a gap between these bodies and these bodies. We could still get a measured move down. Traders will sell below the bear bar on the reversal down. Here's a gap, an actual gap, this low and the breakout point. And then we have several body gaps where the tails overlap, but the bodies do not. Signs of strong buying. The odds are the trend will continue. In small pullback bull trend days, you often see body gaps like this, where the bodies do not overlap, but the tails do, and actual gaps. I began by talking about micro gaps, which are gaps between bars that are 2 or 3 bars away from one another. For example, if you have a bull trend bar, you look at the low of the bar afterwards and the high of the bar before. If they do not overlap, then we have a micro gap, and it is a sign of buying pressure, and chances are the market will go higher. A gap open bar, if the open of a bar is above the close of the prior bar, it's a gap up open bar. If the open of a bar is below the close of the prior bar, it's a gap down open bar. If you get a series of gap up open bars early in a bull trend, that's a sign of very aggressive buying, and the market will probably go higher. In a bear trend, it's a sign of aggressive selling if you start to get gap open bars to the downside, the open of a bar below the close of the prior bar. Any kind of a gap is a sign of strength. If you're getting gaps up in bull trends, it's buying pressure. The market will probably go higher. Gaps down in bear trends, a sign of selling pressure. The market's probably going lower. Body gaps, a gap between the bodies, a pullback bar. If its body does not overlap the body of a breakout point bar, then you're probably going to get a measured move. It's not quite as strong as a completely open gap, but it's still a sign of good pressure, and it increases the chances of a sustained trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on gaps.